All right, let's dive into something that's been bubbling under the surface of the financial world, something that, personally, I think could have massive implications for not just Wall Street, but for everyday investors, especially those with superannuation funds. Here's the deal: credit default swaps, or CDS, are flashing warning signs, and they are pointing straight at the Magnificent Seven, the big tech giants. What's fascinating here isn't just the numbers, though they are staggering. It's the story they are telling about risk, debt, and the future of the tech boom. First, let's unpack this. Credit default swaps are essentially insurance policies against a company defaulting on its debt. Think of it as a bet that a company might not pay back what it owes. Now, the cost of these swaps for companies like Oracle, Microsoft, and others in the Magnificent Seven is at record highs. What makes this really interesting is that it's not just about these companies borrowing more, which they are, to the tune of over $600 billion, but that investors are increasingly worried they might not be able to pay it back. In my opinion, this isn't just a tech story, it's a systemic risk story. Here's where it gets even more intriguing. The AI hype cycle has been fueling this debt binge. Companies are borrowing to build out data infrastructure, betting big on AI delivering massive returns. But what many people don't realize is that this isn't just about tech companies taking on debt, it's about the interconnectedness of this debt. For example, Microsoft finances OpenAI, which then integrates its models into Microsoft's cloud services. If one of these players stumbles, the domino effect could be catastrophic. From my perspective, this circular financing is a ticking time bomb. Now, let's talk about Oracle, because it's front and center in this narrative. Last year, Oracle struck a $300 billion deal with OpenAI to build out cloud infrastructure. Sounds impressive, right? But here's the kicker. Oracle's credit default swaps have skyrocketed from just above 0.4% to over 2% in a matter of months. That's a massive jump, and it's a clear signal that investors are nervous. Personally, I think Oracle's aggressive borrowing to fund these deals is a red flag. If the AI investments don't pan out, Oracle could be in a world of hurt, and so could anyone exposed to its debt. But let's zoom out for a second. What this really suggests is that the entire tech sector's debt-fueled growth could be on shaky ground. Dan Rasmussen, a US investment fund founder, puts it bluntly: the credit metrics are deteriorating. Cash flows are drying up, debt is rising, and the ratios are looking ugly. If you take a step back and think about it, this isn't just a problem for tech companies, it's a problem for the broader market. The Magnificent Seven make up about 30% of the US stock market, and roughly 20% of Australian superannuation funds are tied to Wall Street. That's a lot of exposure. Now, not everyone is hitting the panic button. Rodney Commages from Vanguard Capital Management argues that these companies aren't a monolith, they have different business models, and it's unlikely they'll all fail at once. Fair point. But here's the thing, even if just one of these giants falters, the ripple effects could be massive. A detail I find fascinating is how quickly sentiment can shift in markets. Just a few years ago, these companies were seen as unstoppable growth engines. Now, investors are hedging their bets like never before. So, where does this leave us? In my opinion, this is a wake-up call. The debt-fueled AI boom is a high-stakes gamble, and the credit default swap market is telling us the odds aren't looking great. If the investments don't pay off, we could see a market-wide re-rating, impacting everything from chip manufacturers to energy grids. And for everyday investors, especially those with superannuation funds, this raises a deeper question: how much risk are we really comfortable with? Closing thought. The Magnificent Seven's debt binge isn't just a Wall Street problem, it's a global one. As we watch these credit default swaps soar, it's worth asking: are we witnessing the peak of the tech boom, or the beginning of its unraveling? Personally, I think the next few years will be defining. What do you think? Let me know in the comments below.